Welcome back to the XRP Insider Network. This is the channel where we go deeper than headlines, deeper than hype, and straight into the power dynamics shaping the future of money. If you care about where the financial system is really heading and not just what's trending on social media this week, make sure you like this video, subscribe to the channel, and turn on notifications because today's story connects dots most people still don't see. Here's the uncomfortable truth. Banks are trying to build their own version of XRP, not publicly, not loudly, but deliberately. And in the process, they've accidentally revealed exactly why XRP is still light years ahead. This isn't speculation for clicks. This is about incentives, architecture, and control. For decades, banks owned the rails of money movement. Cross-border payments ran through slow, opaque systems, swift messages, correspondent banks. Nostro and Vostro accounts scattered across the globe. It was inefficient by design because inefficiency created leverage. Money moved slowly, fees stacked up, capital stayed trapped, and the banks stayed in charge. Then blockchain arrived. Suddenly, value could move the way information moves, instantly, globally, without asking permission at every checkpoint. That was the real threat. XRP wasn't built as a retail experiment or a meme asset. It was built to attack friction at the infrastructure level. From day one, the idea was simple but radical. Use a neutral digital asset to bridge currencies instantly without requiring banks to trust each other or pre-fund accounts around the world. That neutrality is the key. XRP doesn't belong to a country, it doesn't belong to a bank, it doesn't favor one currency over another, and that's exactly why banks hesitated, because adopting XRP fully means admitting they no longer own the rails. So instead of embracing it, banks chose a different path. They tried to copy the outcome without copying the openness. Private blockchains, permissioned ledgers, internal settlement tokens. On paper, these systems sound advanced: instant settlement, tokenized deposits, blockchain-based transfers. But look closer and you see the same old structure: closed access, central control, fragmented liquidity. These systems only work inside one bank or inside a tightly controlled consortium. That's not a global solution. That's a local optimization. And here's where the illusion breaks down. Global finance doesn't fail because banks can't move money internally fast enough. It fails because money gets stuck between institutions, between countries, between currencies. That's the problem XRP was designed to solve. Private bank coins don't solve that problem. They recreate it in digital form. Each bank builds its own token. Each ledger has its own rules. Each system requires trust agreements and legal frameworks. So instead of one bridge, you get dozens of islands. Liquidity becomes fragmented, complexity increases, and interoperability becomes the bottleneck. XRP removes that bottleneck. One asset, one settlement layer, one neutral bridge. That's why XRP doesn't need permission. It needs liquidity, and liquidity follows efficiency. This is where the time advantage shows up. XRP isn't racing to catch up with banks. Banks are racing to recreate what XRP already does without surrendering control. And that's a race they can't win because the moment you add control, you lose neutrality. And the moment you lose neutrality, you lose global scalability. This is the core contradiction at the heart of bank-issued coins. They want speed without openness, efficiency without decentralization, innovation without disruption. That combination doesn't hold. If this breakdown is helping you see the bigger picture, take a second to like this video and subscribe. It helps this channel reach people who are trying to understand the system, not just speculate inside it. Now let's go deeper into why banks keep trying anyway. To understand why banks keep building their own XRP-like systems, you have to understand what scares them most. It's not volatility, it's not regulation, it's trapped capital. Right now, trillions of dollars sit idle around the world in pre-funded accounts just to make sure cross-border payments can settle. That money isn't earning, it isn't investing, it isn't productive, it's insurance for a broken system. XRP eliminates the need for that insurance. Instead of parking money everywhere, liquidity can be sourced on demand, settled in seconds, and released immediately. That changes the economics of banking. And when economics change, power shifts. Banks see this. They understand it intellectually, but emotionally and politically, giving up control of liquidity rails is a massive leap. So they compromise. They say, let's use blockchain, but only inside our walls. That's where private coins come in. These systems speed things up internally, but they don't solve the global problem because the moment money needs to leave the system, you're back to trust, correspondence, and reconciliation, which means the friction never really disappears. It just moves around. This is why even central bank digital currency experiments struggle. Each digital currency is optimized for its own jurisdiction, its own rules, its own monetary policy. They don't naturally talk to each other. And when they try, they run into governance issues, legal conflicts, and political hesitation. XRP doesn't care about borders, it doesn't care about politics, it just settles. That's why XRP keeps showing up in pilot programs, proofs of concept, and cross border trials, even when it's not mentioned in press releases, because engineers follow efficiency, even when executives follow optics. Now, here's the irony most people miss: the more banks build private coins, the clearer the fragmentation problem becomes. Every new ledger adds another integration point, another compliance framework, another liquidity silo. At some point, the system becomes too complex to scale. And that's when neutral bridges become unavoidable. This is the same pattern we saw with the internet. Before the open web, companies built private networks, walled gardens, closed ecosystems. They worked until they didn't. Because once global connectivity mattered more than control, the open system won. XRP is following that same trajectory. It's not flashy, it's not loud, it's infrastructure. And infrastructure always looks boring right before it becomes essential. This is why XRP doesn't need to win every narrative battle. It just needs to keep working. Banks can delay adoption. They can experiment with alternatives. They can posture publicly, but liquidity doesn't lie. It flows towards speed, cost reduction, and reliability, and XRP already delivers those at scale. That's why this isn't a question of if, it's a question of when. And when the shift happens, it won't come with fireworks. It will look like systems quietly switching over, back-end integrations, invisible upgrades, and suddenly the bridge everyone resisted becomes the bridge everyone depends on. Now let's talk about why this transition is slower than people expect and why that actually benefits XRP holders who understand the timeline. The biggest mistake people make is assuming financial revolutions happen quickly. They don't. They happen slowly, then all at once. Banks move cautiously because they're regulated, but also because change threatens their existing advantages. Every year they delay full adoption of neutral bridges is another year they try to preserve legacy power structures. But that delay comes at a cost. Global trade doesn't slow down. Remittances don't disappear. Emerging markets don't stop growing. The demand for faster, cheaper cross border payments keeps increasing. And eventually, the cost of not using the best tool becomes higher than the cost of change. That's the tipping point. XRP is positioned for that moment because it was built before the demand fully arrived. It's already battle tested, already scaled, already integrated into real payment flows. Bank coins are still experiments, still fragmented, still political. You can't negotiate physics. Speed is speed. Liquidity efficiency is liquidity efficiency. And systems that rely on trust will always move slower than systems that rely on math. This is why XRP is light years ahead, not because banks are incompetent, but because they're constrained. They can't fully embrace neutrality without undermining their own control. XRP has no such conflict. It doesn't need to protect legacy systems. It doesn't need to preserve margins built on inefficiency. It just needs to work. And it does. So when you hear headlines about banks launching new coins or building private ledgers, don't see it as competition. See it as validation. They're acknowledging the problem XRP identified years ago. They're just trying to solve it without giving up the keys. History shows how that ends. Open systems outscale closed ones. Neutral infrastructure outlives proprietary alternatives. And bridges always matter more than islands. This isn't a short-term trade, it's a long-term infrastructure shift. And the people who understand that aren't waiting for hype, they're watching the plumbing. Because when the plumbing changes, everything above it follows. That's why XRP was never about headlines, it was about inevitability. And that's why even as banks try to build their own versions, XRP remains exactly where it needs to be, ahead of the curve, ahead of the copies, and ahead of the system that's still catching up.